What's up, everybody? Welcome to the life cycle of a trade, the series where we break down the thought process behind trade entry, trade management, and closing order. In this video, we're going to cover a covered call. There's a stock that I'm looking at that I like to trade as a proxy to Meta earnings. So Meta has earnings after the close today. One of the stocks that I like to look at is Snapchat. Snapchat tends to move with a relatively high beta to Meta earnings. So if Meta is up on earnings or reports good earnings, you typically see Snapchat kind of have that similar sort of move. And Snapchat at $11 stock, it's still a big company, $18 billion market cap, so it's not a small company. And it has earnings coming up in early February into next week, so that is in play. I think it's an interesting trade for a smaller sized account, $5,000 to $10,000 account is certainly a position we can put on here. So I was thinking of doing just a standard covered call. So covered call is a long stock position, and you can see in a margin account, you get significant relief on the notional value of the stock. The stock, if you were to pay cash, 1-to-1, it would cost you $1,100 and change to be long the stock in a cash secured account or an IRA account. In a margin account, it only uses about $500, $563. You get about 50% margin relief relative to the notional value of the shares. So it's a very capital efficient trade. $500, well within our wheelhouse here. I was thinking we could actually go into next week's weekly expiration. So the 9-day expiration, you can see earnings are on the 4th. So this option will expire the week of earnings. And so you're getting that extra implied volatility, which you can see 140% implied volatility. I mean, February still has very high implied volatility, so you could certainly do that too. Volatility is not the issue here. There's volatility across the chain here. But I want to get into the one that has the most volatility and has the most exposure to earnings, because this is not a stock or position that I intend to hold for a long period of time. This is a trade that I'm trying to make to the upside in Snapchat. So I'm going to look at this 12 strike call. So when we look at this 12 strike call, you're netting out at about 50 to 60 long deltas, which isn't a ton here. At 80 cents, that gives you a max potential profit of somewhere around $160. We can look at this on the analysis mode here. You're getting 80 cents for the call, and you have about 80 cents of upside potential in the stock move. If the stock were to go to 13, you'd make $80 on the upside, $80 on the call. So your risk, so to speak, of missing out is somewhere around 13. We'll call it 13 just to make it a round number. Above that, we don't make any more than we could have made just owning the stock. So if the stock goes to 12, this is great. This is more than we would have made just owning the shares. Stock goes to 13, we miss out on some to the upside, which I'm not worried about, because this is a trade. I'm trying to get in, trying to get out at the end of next week. So you can see our buying power, $400 and change. Max profit, $154 now. With the move in the stock, we missed out on 5 or 6 cents and a penny or two on the option. But it's still a nice return on capital for just a couple days hold time potentially. And if we don't get that move, we can then wheel into our standard covered calls 40 some odd days out in time, close at the money, because I'm not trying to stay in this trade. So we're going to route this here, 1046, see if we get filled on our little covered call position. Long a stock in a small sized account, a rare occurrence. So there we go. We got filled on our trade. We're in at 1047, which means that we've got about $153 of potential max profit to the upside through the end of next week on just about $500 in buying power. All right, so we had Snapchat earnings after the close yesterday. The stock actually was looking to be higher. If we go to just a shorter term chart, we can show just how high it got. So it did in the overnight session get into the 13-14 handle. It looked like it was going to be a perfect move for our covered call position, but of course stock is now down 80 cents from its close. So it reversed that entire move in the overnight session. When we get back into the chart, we are nearing the lower end of where it's been trading here. We have this covered call where we bought 100 shares, sold the 12 strike call against it. When we actually bought the shares, you can see from here, we actually bought them at $1.25, but we sold that call for a pretty decent amount of premium. We could show that on the chart as well. If you right click on the 12 strike call here, we can show what that was trading at the time. So we sold that at 78 cents. When we look at the position net, we're actually up money on the trade. So going back to the order chains here, we're long 100 shares at 11.25. We sold that call at 78 cents, basically marked at zero. So we've captured all that premium, and it's actually hedged us on this downside move. Now with covered calls being long the shares, you can continue to roll this call and participate in this position and continue to reduce your basis. So that's what we're going to do here. We're going to just buy back this call. We're going to buy back the 12 strike call. We're going to go to March here. And when we're looking at this position, we have a couple different options here, right? So our basis on the trade overall is 1047. So even if we were to sell this 7 strike call, or I'm sorry, the 11 strike call for 70 some odd cents, you would think that because we bought the shares at a higher price, we would still be below our basis. But because we've collected so much premium, the 78 cents from the original call and then the 70 some odd cents from this call, this would still leave us in a net profitable position, even if the stock were to go above 11 and we were called away at $11 a share, because we've collected that premium. That's the value that we have here. You could also consider selling like just the 12 strike call. The 12 strike call at 40-ish cents gives you about $1 a day in premium decay with 44 days to go till expiration. It's a little bit cheap for me, so I'm going to lean into this 11 strike call. It's right at the money. If we do get a move above 11, we're set to make about $150 just from the premium that we've sold. That's the 78 cents from the original open and the 73 cents from this rolling trade, minus the 40 some odd cents that we paid above that 11 strike when we bought the shares originally. We go back here. So 25 cents. So minus the 25 cents puts us at about $125 of max profit if we get above 11 in the next 44 days through the expiration. That would be our profit potential here on this trade. So we're going to go ahead and do this roll, and you'll see our prices adjust here once we get there, and we'll look at that too. So we'll do this at 73 cents. No fill there. Let's move this down to 72. All right, so we're in a 72 cent credit. You can see my basis on this position now is $9.75, which means that if the stock rallies above 11 and our shares get called away, so it doesn't matter if it goes to 11 or 12 or 13, we would get called away at 11. Our net profit on the trade would be the $9.75. Relative to the 11 strike would be $125 of max profit on this trade if we rally above 11. Of course, the caveat to the position is that you're capped out at 11. If the stock were to go to 12 or 13 or 14, you miss out on that extra value to the upside. But in exchange for that, you get that 70 some odd cents of basis reduction, which further reduces our overall net position to the 975 you see there on the right side order chain. So we'll see if we get a little bit of a rally into the next 30 days or so and see if we can exit this for maybe $100 profit or something like that. If not, we'll be holding to expiration and let this one get called away. So stay tuned for the next adjustments on this trade. The stock is down $1.50-ish, so it's had a pretty big move to the downside, but we've collected so much premium that we're actually at a scratch on this trade. So the position is marked at $9.72. Our basis on this trade is $9.75. So we're out 2-3 pennies, nothing really. Stock has dropped significantly, and that's really the benefit of covered calls, is they hedge you to this, 3 to 5% down move that we have in the stock. throughout this duration of the trade. So at this point, we have a call that's basically worthless, right? So we have the 11 strike call. It's trading at 10 cents, 15 days to go till expiration. It's really not helping us at all with this position. There's no more premium. There's $10. It's less than $1 a day in decay throughout the duration moving forward. So we're going to take that call. We're just going to do a simple rollout to April. And now when we roll out, you could certainly go to the 11 strike call. And I know the 24, 25 cents, it seems like it's nothing. But when you think of it relative to the stock price, with the stock trading, let's just round it to $10, it is a couple percentage points. And if you are doing this consistently rolling for a year and you're collecting 1 or 2 or 3% of a basis reduction relative to the stock, that's going to be a really significant amount at the end of the year or over multiple years, assuming the stock stays range bound. Now, for me on this position, I'm not in love with Snapchat, and this isn't a position that I plan to hold for a super long duration. I would rather just take money and run on this position. So I'm going to go right at the money to the 10 strike call here at about 61 cents. What that'll do is it'll give our break-even price, and our average trade price will be down to like $9.10, which means that if the stock is above $10 at the end of this April expiration, we would make 80, 90 cents on the trade, which seems like nothing, but when you're looking at this position, it only uses $400 or $500 in buying power, so it's still a 5, 10, 15% return on capital here, even more if we get that move through 10. So it's still a decent return on capital, and of course we can continue with this position if we want to, rolling it out in time if we stay around this $9 to $10 price range. So we're going to make this roll 62 cents. We can take a look at the order chains afterwards. This will reduce our delta down to somewhere around 50-ish long deltas because we are selling the 50 strike call. If we can get filled here. There we go. Oh, we got price improved. There we go. All right, so we rolled that call to the 10 strike. Our basis is now $9.15, so we have $85 of potential upside if we do get this move above 10. So stick around. All right, so we have a Snapchat position here to manage. You could see our average position cost is $9.15. So we've reduced the basis on the stock by $200, almost 20, 30% here on the stock. So nice little basis reduction on a small little Johnny trade stock here. It's basically kept us in the game with only a 60-cent loser. It's basically a nothing burger. So Snapchat, it's a trade that frankly I've had on for long enough, and I would be happy just getting rid of this trade or being out of this trade into some sort of up move. So for me here, I'm going to make the decision to just sell the at the money call. It's a very small buying power requirement position, a couple $100, so I don't need to close the trade. But I'm happy to hold it for another 30 or 40 days if I can make, $50 to $100 on this trade. It's very, very small buying power requirement, still be a high return on capital. I'm going to take this trade and we'll roll to the 10 strike here out in May. We're going to continue with this dream. It's a 50-cent reduction. It puts your basis basically right where the stock is. Hopefully we get a little bit of an up move over the next 30 some odd days, and we could close this trade within the next 30 or so days. 9.5 on the stock would be absolutely perfect. It'd be a $50 or $100 winner. Of course, if it blows through that, it does have earnings coming out on April 24th. If it blows through that strike, beautiful. I'm out with a very nice profit. It'll be a $150, $200 profit if we get above 10. So we're going to make that roll for 50 cents here, about $1 a day in theta decay, just based on the duration left on the trade. Let's see if we can get our 50 cents. No 50. We'll get to 49. All right, so we got filled for a 49-cent credit. I know that sounds very small, but when you're dealing with a sub $10 stock, it's a 4 or 5% reduction in basis. So a nice little get for us here in the Johnny Trader portfolio. All right, so we've got a position to manage here. We've got Snapchat. They just reported earnings yesterday after the close. The stock was trading around $9, exactly where we needed it for this cover call position that we've continued to roll. We've been selling calls against it on this way down. The stock, after earnings, drops all the way down to $7.73, basically a new low here in the stock, or just about the lows. Our position, we're only down about $95 with all this premium that we've sold. So we bought the stock at $11.25. It's now trading at $7.75-ish, and we're only out about $100. Our basis on this trade is $8.66. That's including all the credits that we've collected along the way, with the mark of the position at $7.71. Now, we had this call that yesterday was trading a lot higher than where it is right now. It's trading at about 50, 60 cents. It's basically at zero now. So what we're going to do is we're going to continue rolling this position. We're going to fight the good fight here, see if we can get this one back to a profit or close to it if we do get a rally. So again, our position, when we look at Snapchat, our basis on this trade is $8.66. So if the stock were to get to, $10, $11, that would be perfect for us here. So if we can take this position, we buy back this call, we can roll this out to June. Now, when we're looking at the June options, they are very, very cheap. And that's because the stock is very, very low, obviously. So one of the things that you can do to the upside to sort of give yourself extra potential value to the upside here is to do a call ratio spread. So we certainly could sell this call, let's say the 9-strike call, at 27 cents. And if the stock does rally, we would get called out at 9. We'd collect another 27 cents and make us like a 50-cent profit or so on the trade. In a trade like this, where the stock can only go to zero, and hopefully it doesn't, we want to get some more bang for our buck to the upside. So what I'm going to do here is a little bit of an interesting trade here. So I'm actually going to do a call ratio spread to the upside here. And what this does is this gives us from 8 to 9, we actually have the ability to make $200 on that move because we're long that 8-strike call and the stock at 7 and change. So if we get a move to 9, we would actually make the $140 on the stock move, but also another $100 on this move to the upside from 8 to 9. So this would actually give us, an extra $100 or so in profit if we can get a move up to 9. So this sort of accelerates the upside here on a trade that has gone very much against us. It's almost like a doubling down on a long delta play here. So it does cost a small debit for this trade, which I'm fine with. If we get a move to 8.5, that's still a positive for the position as a whole. So we're going to make this adjustment here. We're going to roll into a call ratio spread into this move, and we have to buy back this call too, so we can put that in there too. So it'll be about a 10-cent net debit on this trade. There we go. So we did that for a 10-cent debit. You can see our basis on this trade is $8.76, which means that if we get a move up to 9, the basis on this whole position would be basically a 24-cent profit. Plus, we have this dollar of potential value between 8 and 9, which would net us out at $125 profit if we can get to 9 within the next 51 days. So stick around. All right, so we have a fairly unique situation here with our Snapchat position, which we have been in since January. You can see I now have 200 shares of stock here at a basis of $9.62, and that's because I actually got assigned on a long call that I had that expired slightly, like 2 ticks in the money for the June expiration. I was actually out of town for when this happened, so it was a little bit of a surprise when I woke up to see that position. It was on June 20th, so when we go to the chart here, you can see the close was at 8:01 in the upper left-hand corner there. 8:01 was the close of the session, and so my long option was actually exercised. It was part of a ratio spread that we had done a little while back. We did it for 10 cent for a 10-cent debit. We rolled from a 10 strike call that we were short to an 8-9 ratio spread. So I actually got long another 100 shares of stock at 8, which puts my overall net basis on my $2 cost averaging, for lack of better words, at 1160 and change, and then at 8 puts me at that 960 basis for my stock position. So this overall is actually a nicely profitable trade. So what I do is I go to the history transaction tab. So like when you go here, you go to the history tab, you can type in the symbol, you can change all these filters. I did the year to date. It'll add up like commissions and fees and the total amount of the premium that you've collected. So this is an interesting thing to use when you're looking at stock positions, because it takes all your options and stock positions together. You can even select specific spots. So here, this is just my shares. So you can see my shares. I have 200 shares at $1,900-ish, which comes out to be, about $9.50 or 60 cents here, just rounding. When you take that off, it actually includes all of your credit and debit and rolls, all that good stuff, which means that my total basis on these 200 shares with the premium that I've collected is about $800 and some odd dollars here. So we'll call it $845 a lot. So we have a couple options here. Do we continue with this trade or just let this one go and take the gift that we got here? And I think that we just take the gift here given the move that we've had. So when we look at the going back to the chart here, you can see my basis on the stock 962, but that doesn't tell the story of all the rolls that we've done with this trade. So we're going to go here. We're going to sell out of these 2 shares of stock. Maybe we roll into a new short put into maybe a down move here at some point. So stock's up 10% today. It's a good one for me. I'm out. So we're going to close this out at 950. We'll see if we get filled here. Not that I need that buying power back, but we could see here. So when we close out of these shares, you can see my order chains here. So we started this as 100 shares, selling the 12 strike call. We did that at 1047. We've been rolling. We rolled again and rolled to an at-the-money call ratio spread to try and get a little bit of a move higher and close out into that move to 9. That would have been a perfect situation for us. We actually got assigned on that position on that 8 strike call and ended up closing it today at 950. We net out 200 some odd dollars. A nice battle. You got bailed out on the stock. The stock moves 10% today. It's great. Yesterday we were about a scratch on this trade. We made most of the money today into this move, into this 80-cent move times 2, 160. That's most of our profit here. But really, the mechanics here just shows you that just over time you can reduce your basis, collect some premium, and overall, give yourself a lot more a higher probability of potentially exiting for a profit. So good little trade for the Johnnies. Happy about that one.